Hello, everyone. This is Ernie Humphrey, the CEO of Treasury Webinars. I'd like to welcome everyone to our webinar today, Cash Forecasting, Understanding the How and Why of AP, AR, and Market Dynamics. Quite a mouthful there. A subject that is near and dear to my heart, and I'm really excited as far as what has been emerging in terms of technology, in terms of helping us understand the why of cash movement. So that's something that's really incredible, especially from my days struggling many years ago. Before we dive in, I want to thank my webinar partner today, TIS. They share my strong commitment to thought leadership, but also probably more importantly, they share my commitment to impacting the career success of Treasury and Finance and everyone up and down the office of the CFO. Let me go ahead and welcome my esteemed co-speaker before we dive into the housekeeping items. I'd like to welcome John Paquette. He's the Vice President of Solutions in the U.S. for TIS and one of my favorite co-speakers. John, why don't you give us a little bit about your background before I dive into the housekeeping items?
Sure, and thanks for the intro, Ernie. So John Paquette, as Ernie mentioned, I oversee our solutions team for TIS. So that's our solutions architects and our onboarding team as well. Came from the practitioner space though, so I spent 15 years as a Treasury practitioner directly, managing Treasury functions for organizations in the U.S. before I made the jump over to the technology side in 2019. So happy to be here. Looking forward to the webinar.
All right, thanks, John. Few housekeeping items. If you'd like a certificate of attendance for today's webinar, you'll have to answer all the polling questions and remain on for the duration of the webinar. If you would like a copy of the presentation, please send an email to Ernie@treasurywebinars.com. Again, that's Ernie@treasurywebinars.com. Also have a very short survey at the end of the webinar so you can help me improve the ROI that I offer to you for your valuable times. Webinars are a crowded space, I know that, and we are honored and humbled that you are giving us your valuable time today. We will make it worth your while. Again, a lot of content. If you want to copy the presentation, Ernie@treasurywebinars.com. So here is the roadmap for our journey today. So I like to talk about cash forecasting in really two different segments. One is what happened, and that's where I spent a lot of my time as a Treasury practitioner, and some of us still have issues in that, right? What happened, right? What is the bank account activity? How do I get visibility to it, right? All across the world, all across the globe. That's still tremendously important and still difficult, right, for many organizations, but companies like TS are making that a lot easier. And then my whole soapbox right now is why it happened. And so that is where the value comes in with all the technology that we're being used. Why did it happen, right? When we understand the why of cash payments going out and coming in, that's where we really start to see the value. And of course, everything is driving variances right now, but especially accounts receivable with all the global issues that we're having. I like to call these exogenous factors. And then we'll share a little bit of research, cash forecasting, and then we'll dive in pretty deep around the how of cash forecasting, the way that I like to look at it. And then we'll talk about variance analysis, then we'll talk about how to leverage the technology, and then we'll give you a very basic framework for you to assess the ROI of your cash forecasting. So fast and furious. So let's go ahead and jump into the little bit background on the what happened. John, let me go ahead and hand the floor over to you for our next few slides.
All right, thanks a lot, Ernie. Yeah, in terms of cash visibility, there's probably nothing more, I don't know if important is the right word, but foundational to treasury management than just having fundamental sort of cash visibility, right? It forms the basis of so many different activities. Of course, it plays a major role in cash flow forecasting, right? You can't project out where you're going to end up if you don't know where you are today. And then also with the characterization of your receipts, your actuals, and things like that, right? You really need full cash visibility to be able to achieve that. And I think what this chart does is call attention to not all organizations really have that, right? There's a good percentage here, about 40% that have less than 75% visibility into their accounts. So if you're looking for sort of a launching off point for your technology investment, this is kind of like square one that we usually tell a lot of organizations, really focus on this, get this squared away, right? Because just by having this visibility, understanding what you have for cash on a day-to-day basis, but also having that visibility to what's flowing through your accounts, you learn so much, you can manage so much better, and it puts you in a good position to really understand your cash flows when you do get into forecasting. And then also, it's, we talk about the topic of cash visibility, and people sometimes ask us, hey, can you define that a little bit? Because, I can run a prior day report on my banking portal anytime I want to and see what my bank balances are and what my cash transactions is. But, is that true cash visibility? Maybe if you're a very simplistic organization, it's only, banking with one particular banking partner, only a handful of accounts. But, it's probably twofold. It's the visibility, the ability to get the information, but the ability to kind of get it in a way that you can then actually analyze it, draw insights from it, right? And so there's a lot of good points here. What information can you see? Can you see all of it across all your bank accounts and all your bank relationships? How frequently can you see it? Sort of what's the mechanism for pulling in that on a day-to-day basis? And then, the more important part is what can you actually do with it, right? And are you receiving the level of detail you need to actually do what you want to do, what you want to achieve with your business? So these are definitely good questions to consider when you're sort of assessing whether or not you have full cash visibility. This slide here is another interesting one, I think, too. This is actually from a survey we launched with Treasury webinars right at the end of 2021. It was kind of forward-looking into, what are people looking to get out of technology investments in 2022? And you can see the bar across the third to last points here. Gain better visibility into key data to drive better decision making. This is a huge topic right now. It seems like you can almost trace it back to, I think, a lot of the volatility, unpredictability that we've experienced in recent years, maybe going back to the pandemic, but certainly there's been other factors that have come in since then, is that I think people realize that, things are a bit abnormal, and that you really, in addition to just, having data, having visibility, you need to be able to derive insights from that to be able to manage that unpredictability. And it really set us sort of in motion in a chain where people had very pointed objectives for their technology investments in terms of synthesizing that data and being in a better position to manage their business as a result of that. So I think you definitely see that show up here in this survey result.
All right, thanks, John. So one of the points that I want to make here, just I guess it makes me feel all warm and fuzzy inside, that getting better visibility, right? I've been saying you can't manage what you can't see. It's not my term, but for a long time. So that's really encouraging to see, but also it's encouraging to see increase the security and control around the financial processes. And one of the things that technology helps us do, and TIS is leading in this, is also sanction screening as well. A lot of the dynamics going on, right? You want to make sure that you're doing business as allowed. So there's a lot of risk exposures that can be mitigated when you have that visibility. So John touched on the what happened. So I call it your cash IQ. So let's kind of dive in to why it happened. And so one of the things that I want to say is, again, just to show you how important that is. I know we got a lot of Treasury folks out here, but why cash forecasting is important. It's important because it impacts our cash management. But if you look at how companies measure Treasury success, right? Free cash flow, operating cash flow margin, right? So all those things are related to cash forecasting accuracy. But this is another webinar. It was great to see that employee engagement was so high on that level. And just a quick note, I'll be working with TIS, and we are going to be launching a survey that has some of those same questions later on in Q4. So look for that and please participate, and we'll be seeing if these trends are going to continue. And so let's talk about, I like to talk about it, how do you demystify, right, the why? So what are the sources of variance? We see accounts payable, right? So we talk about, okay, how do we get visibility in accounts payable? But some of you that might not be in the weeds, what does that mean, right? So we need visibility into all these areas of the process, how we capture code and send data, how we verify and approve. And for us Treasury folks, we really like people to understand the approve, because it was really difficult for us to be approving not only one payment, but a batch of payments. If we can't really see the background of that, how are we supposed to make an educated decision on whether or not we should approve this payment, authorize for payment, look at your systems integrability, and then of course your access audit ready details. And so not only does it give us visibility, it gives our internal auditors visibility, it gives our external auditors visibility, and that's important on many levels. But for me, that's really important in terms of our making sure that our risk management controls are in place, our separation of duties. And so that's just an added benefit of having that visibility into it. And then the visibility, right? I kind of look at it when I can break it out, people, process, technology, right, into the people, because especially in terms of risk management, these are the people that create your risk exposures, but then also these are the people that are going to impact your efficiency, right, of your AP process end to end, and they can also impact the success that you have in terms of taking control of how and why you make those payments and optimizing your working capital. So just to give you a sense of all these things that we want visibility into, okay, Ernie, what do I need this for? Who are all the people involved? I need visibility into what they're doing, why they're doing it, are they complying with my policies? You have procurement, right? They should be responsible identifying and vetting suppliers, negotiating contracts. It would be nice if our finance team was involved in that. We'd like visibility into that. We'd also like visibility into that when we're talking to our suppliers. You want to look at the payment terms, right? You don't want to start getting on the phone and having an argument with someone. Maybe their terms are 60 or 90 days, right? Supplier onboarding is important. Supplier information and relationship management. We have an entire webinar on that coming up in September. And then your approvers. And so that's very important. And then some more research information, which I find interesting. Again, we'll be running the survey again. So it's going to be interesting to see. And so we want to understand the why of payments, right? And so we start to look at, in terms of cash forecasting, we want predictability, right, in our payments and when they're going out, and we'd like to optimize the timing. So we need to understand internally why payment types are being made. So what's the reason, right? It's kind of good to see that you have 46% processing costs, 37% suppliers. So that's good. What we don't like to see is on the other side of there, the other 50% that it's just kind of business as usual there. So that's something that we should collaborate more with AP, but that helps us understand the why. Obviously, in terms of the why and predictability, there's going to be a lot more predictability on when those payments are going to hit if you actually use electronic payments, but you have to have that visibility as well. So then we wanted to dig in a little bit deeper into the why. So companies, okay, are you collaborating with your suppliers, right? So we asked folks, if you collaborate, only 52% agree. So I'm not going to get on my soapbox right there, but I think it's always important. The more you collaborate, the more control you have. The more control you have, the more efficient, the more secure. But also in terms of our content today, you bring more predictability into the accounts payable arena. John, can you share with us, did you have any issues that you faced in terms of AP and the predictability and things that you uncovered that helped you improve the accuracy you were getting from that side of it?
Yeah, I mean, I think so. I mean, I think the tighter collaboration you have with those departments, the better, plays into the forecast. Obviously, there's ways that you can project out what's going to be coming up for AP disbursements if you have invoice level detail going into whatever you're using for forecast purposes. But depending on the completeness of that data and the integrations you have with those systems, you might have to supplement that with actual interactions with that department. So I think that that's a really good point to make sure that you're plugged in. They have the best information about what's coming up for AP runs, or understanding variances and what you projected versus what actually went out. That's probably another piece of it too. Also, really good point, I think, about a lot of organizations. I think it was a third of them just making payments because the method they choose, because that's just the way it's always been, right? Not really thinking strategically about that. And that's definitely a place where Treasury can help in making suggestions, right? Moving things over to ACH or virtual card or supply chain financing programs and things like that to actually make, result in improvements in working capital, which you'll see through your forecast, obviously, right? As you kind of, see the improvements in cash flow through, suggesting better payment methods as well. So.
All right, perfect. Thanks, John. So I'm going to go ahead and speed myself up a little bit. I've got a lot of detail in here. Again, if you'd like a copy of the presentation, Ernie at treasurywebinars.com. So the slides I give you to drive through the process, what that visibility means in terms of people and process, right, in terms of AP. So that visibility, a little bit more detail, just another way to look at it. Some people digest information more efficiently with graphics, and so run through that same exercise in terms of people as well, people and process and optimization. So what I've seen in research in general is when you ask folks what's the main source of variance, it's usually AR is still at the top, especially now with all the exogenous factors going on. But again, visibility into the people, this is really what you need. And let me go ahead and I want to bring you in here, John, because I believe this is one of your TIS, one of your amazing content that you produce. So can you kind of drive us through this? And this is really about visibility and optimization across the enterprise.
Yeah, I mean, that's exactly it. So we usually use this graphic to talk a lot about how, businesses are inclined to think of certain processes in these silos, right? AP is one silo, they make payments, they have data that has an impact on the cash forecast, payroll another one, accounting. But, in a lot of organizations, these functions are not really unified in a lot of ways, and that leads to a lot of inefficiencies. And one is just sort of the use of technology in terms of how people are making outbound payments. So there's a big component of that in here, but more framed up to this conversation, I think it pertains more to data. If you look at all these enablers here, they're all the keepers of data that you really need to facilitate your forecasting process. You need that AP data, the payroll data, the information from Treasury, really to get into some sort of unified system. That typically is the biggest challenge for organizations when they're trying to automate and improve their cash flow forecasts, is that they can't get all the data together and synthesized in really a standardized way. They're pulling certain data from one system and then another system, combining data in manually, and maybe ultimately the output is in Excel. But trying to come up with some strategies, which we can give you a little bit later on in the webinar as well, for how you might be able to get all this data together to view this from an enterprise standpoint. There's huge benefits here.
Yeah, thanks, John. I think one thing I want to I didn't really touch on enough was, and you kind of touched on this a little bit, John, in working with AP. So in Treasury, I think we're probably guilty a little bit of not going back to the people that probably have the most insights into the why. So let's say our cash forecasting variance has ticked up or is going the wrong way. And so let's say, oh, that looks like accounts payable. Well, why don't you go to the accounts payable people and talk to them and see what their insights are, right? Get their insights as to why and how you can work with them, right, to improve the predictability of that information. So that's key on our side from Treasury. Same thing, AR. Maybe you're seeing variance from non-standard payments. Maybe you're seeing things from projects you weren't aware of, right? Company investments. So we want to be proactive and make everyone see the benefits. And so we'll talk about this, understanding who is driving, the variance in the forecast and how we can tighten that up is really beneficial to your company. So let's talk about, you're like, no polling question yet. I know you're all getting antsy, but don't worry, we'll get one here pretty soon. And so I want to share some benchmarks and research that we had done, the survey that we mentioned previously. So just interesting because I've never really seen some of these areas looked at. And so to me, it really explains when we start to look at, okay, what's the variance of the forecast, right? How much does it matter? You have visibility. I say you want all the time, everywhere, right? But it depends on what you're using your cash forecast for. And so we asked folks to share the purposes of the cash forecasting. To me, this was surprising. I guess I wasn't really thinking about it in terms of really that treasurer perspective, but managing capital structure was the most frequent. And so managing short-term borrowings was 47%. I would expected that to be like 100%. John, anything to you stick out here?
Yeah, I mean, that's what I was expecting too, is that, generally the purpose of the cash forecast is for cash management purposes on a day-to-day basis, right? Really being able to project when you're going to have those liquidity shortfalls or surpluses and planning in advance for what you're going to do when those situations arise. So yeah, things like, managing short-term borrowings and, investing excess cash, or maybe planning for key, sort of events in time that are coming up where there's going to be a need for cash, I thought would be probably the most sort of highly voted for components there. You can see things like board reporting, dividend planning, or scoring on the lower side. So you can see a little bit here, I think, that the cash forecast is an operational thing that Treasury uses to sort of manage cash flow through the business, more than like a strategic board thing that's used for some of these other events. So, but yeah, otherwise, I think those are kind of the key takeaways for me in this result.
Great, thanks, John. It's kind of things I'm kind of thinking as I look at this data. Again, to me, this also shows the value of cash forecasting accuracy, but also what it's used for. Now, we'd all like to think that there's only one cash forecast in the company, right, John? But little do we know, we might have our FP&A folks out there, right? So we want to make sure that if cash forecasting is being used across the enterprise, especially for board reporting, right, and dividend planning, that we're all on the same page there. So 2 points on that. Look at the different ways it's valuable, but we need to have control, in my mind, in Treasury about how these forecasts are used and how they're put together, and making sure that there is, yes, I'm going to say it, single source of the truth, which seems to be difficult at times. Looking at the frequency, again, if I would have looked at this before looking at the purposes, I would have been a little surprised, but this starts to make more sense to me. So our survey respondents said 27% daily and weekly. To me, again, I would have just expected that to be a little bit higher on the daily side. I'll be interested to see what that looks like for our survey this year. So just some more research. Again, we talked a little bit about accuracy. So accuracy really matters if it impacts your decision making. And so when you're looking at what is the value, right? What's the value of increasing that accuracy? It's impacting your decisions, and we'll talk about the ROI of that later. Then we also looked at time forecast horizon. Again, where you stand depends on where you sit in terms of the purpose of your forecast. So that's just one of the things that I think was missed, probably maybe it was a long time ago, 20 years ago, if not 15 years ago, is people weren't really thinking, okay, what is the purpose of our forecast? And then driving what makes it meaningful based on that purpose and based on the decision making, right? I always say, they say business intelligence. I say it's only intelligent if it impacts decisions, right? Other than that, it's just information. So let's kind of go into the how here. Let me see. John, you want to take us, or you want me to go through this? I think it's mine still. All right, I'm going to take over. Sorry. All right. So let's talk about the framework here. This framework is from, a lot of it's from a presentation from 2017, the AFP annual conference. This is the best presentation I've ever seen on the how. So I encourage you, you can click on the link and get that presentation. Some great thought leaders there, but you just look at the how, right? The things that are driving it. You have your data and tools, your process and methodology, your behavior and organization. So all these things are going to impact the accuracy that you have. So this is a graph, this is a representation here. The first thing is really, okay, we want to look at the indirect model or a direct model. So just real quickly, those of you who aren't really in the how in terms of cash forecasting, there's types of approaches. Top down is really a macro view, look in the aggregate and then transpose down to business units. So that's really more suited towards our medium or long-term forecast. So probably a little bit more on the balance sheet side and maybe the capital structure side. I'm a proponent of the direct model, given the amount of data that we have now. Looks at segments by business unit, product line, and cost centers. And so I say, how low do you want to go? So to me, this is important, and this to really understand and get at the why of cash movements. I think that's the way to go. Some folks have a combination of both models, and you may actually choose same data, right? Make sure it's a single version of the truth, but you may want to look at a different type of model based on the type of forecast. I recommend being consistent, but that's where a hybrid takes place. So in the direct model, just some of the inputs, and these are things that you all need to make sure included there, right? We say garbage in, garbage out. What are the drivers, right? We have receipts, collections, disbursements, intercompany settlements, payroll and benefit, tax payments, financing, capital expenditures, and then your exogenous factors. So a lot of these can be industry dependent. And so I guess I shouldn't say they're endogenous, because I don't think we can control the weather, but they're things that we need to take into consideration. We can't control FX rates either. I'd be rich. So those are just things I would say that are going to impact your forecast. Partially, some of those things are going to impact demand. I used to work in the water well industry was supplying submersible motors, so we had to, if it was going to be really dry, then that would make our demand go up quite a bit. So that helped us with our forecasting accuracy. So the process, right? You get your forecast, consolidate, variance analysis, and then learn and improve. John, we've got about 8 categories listed here. Were any of these any more the most challenging to you when you were working at cash forecasting?
I don't think so. Not necessarily. They're all, obviously there's different sources for each one of these data points, but I think it's terms of a good understanding of where to get this data from. They're all pretty easy to collect overall. Tax payments maybe more so if you're really collecting information about a lot of different tax payments. Obviously, tax payments are usually estimates, right, that are trued up over some period of time, and then you have real estate tax payments, sales tax payments. There's just a lot of different categories there for local and federal, and even some stuff that's international there to collect. So I'd say that one is one in particular that requires, to your point earlier, tight collaboration between departments. I always had a good open line of communication with our VP tax about what was happening there. Where something like your receipts, your disbursements, you might be able to collect that more on your own through extracts taken from the ERP systems and things like that show the actual invoices that have been dropped related to those activities. So it's probably easier to pull those types of items in. Other than that, I think that's really the only thing that comes to mind here.
Right. Thanks, John. Yeah, to me, and from conversations I've had, you had a very good, I would say, atmosphere of collaboration. And when I worked in Treasury, it's not that we didn't, but I don't think we did a good enough job in communicating to our operations folks how important capital expenditures were in that data information, especially. I probably told the story on every cash forecasting webinar I've ever done, but we were building a plant in Mexico. The gentleman was told to negotiate the contract in pesos, and then they were negotiating dollars, but that didn't happen. And then all of a sudden, hey, we have a payment for the equivalent of $10 million in pesos that's due in 2 days. Oopsie. Yeah. So anyway, so those are things that are incredibly important. Part of cash forecasting that doesn't get enough attention, I don't think, is what about your forecasting by currency, right? That makes it more complicated. If the variances there can impact your hedging positions, your natural hedges, and a lot of other things there that we could talk about for another webinar. So we talked about the different sources. Again, there's a lot of detail here. Happy to share the presentation with you, but it just gives you how to look at the accountability model in all the different facets that are important, right? Behavior, right? What is the level of collaboration and communication? And what about the organization? And so as we go down, we see the input providers, right? And then the person that may be the owner for delivering that piece of the forecast. And so understanding the variance, which we'll talk about later, is important because you need to have visibility and relationships into the input providers, and they need to understand why that is valuable. And so we don't want to have any incentives for sandbagging upper and lower in terms of our input providers, which I think we have all probably faced that work in the forecasting realm. Some of the data and tools we'll talk about. As John mentioned, Excel is usually still a big piece of this. We have ERP modules now, TMS solutions, which we'll talk about at the very end, what that might look like. So BI solutions, CPM, so just a little bit more detail there. Then don't worry, I'm not going to talk about statistics, but there's different ways for the model itself, receipts and disbursements, accrual, back out, pro forma, and then some statistical models. Back when I was in Treasury, I thought I was going to put some statistical model on this forecast and really make the product manager look like he didn't know what he was doing. Well, I tried to do that. He was using a receipts and disbursements model, and he made me look pretty foolish. He was probably at 95%, and I was probably got up to 60 or 70. I think I tried to put some sort of Monte Carlo simulation. So the point here is don't overcomplicate the process, and then reporting. What is it that you want to be looking at in terms of your variance? Again, depends on what you're using it for. Things that you might want to look at, variance analysis, forecast versus actuals, forecast versus forecast scenario models. And you might want to look at the types of reporting, and then the metrics used. There's a lot of different little synonyms there. I won't really mean absolute deviation, so I won't go into those, but just know that those things are important. So in terms of defining the right method and workflow, just some things to take away. Some of these things you're like, yeah, I know these things, but it makes you think, right? That's one of the big things we try and do in our webinars, is just make you think, right? You got to walk before you can run. And sometimes when you figure out, okay, we're here and we're going to run, we want to look back, right, and see, okay, how are we warming up, right? How are we walking before we run? And is there ways that we can improve our performance out of the gate, remove any inherent barriers to cash forecasting accuracy? I think that's an important first step. You need to understand the purposes, right, of your current forecast, understand your data, its sources, and its relative accuracy. So you should have a way to clean your data on the way in, make sure that it makes sense. In this forecasting method, again, do not try and fit a method. Just don't force it, right? Let your data and needs define that. Again, technology is not magic. And then this is an important one, which is a lot easier today with tools like LinkedIn. Identify professional colleagues who face the same challenges and engage them, right? I guarantee if you find a treasury manager in your industry, they are also involved in cash forecasting. Most people are really open to collaboration. So, John, any of those points you think is maybe the most important, or where you might see people that you talk to where just common things, right, that might be most important out of the box?
Yeah, I'd say the second bullet there, the understand your data is extremely important. Just, what are you trying to forecast? What's the source data to forecast that item? What system it's coming from and how it's ultimately going to get into the forecast. Then ultimately, any sort of methodologies you need to apply to that data to sort of derive it into cash from, whatever source it's originating from. That's almost like step one, the mapping exercise we go through with a lot of, our clients, as well as just really, really being airtight about understanding that. And I think you also made a really good point about, selecting a method and like understanding that method and sticking to it, because, it's one thing to be sort of off on your projection, but it's another to be off and then really have no idea why, right? Unless you have a really concrete method for how your forecast is built and you really understand that well, you're never going to be able to determine the why of, why the forecast was off. And it could be business reasons that the forecast is off, or it could be, just sort of forecasting methodology reasons that the forecast is off too. But, it's a key part of that continuous improvement.
All right, so I'm going to go ahead and everyone wake up. It's time for your first polling question. I know you're all paying attention because John and I are amazingly compelling speakers. So just asking you, just how do you react? Do you understand the reasons for your forecast variance? Strongly agree, neutral, disagree, or strongly disagree? Please be honest. We're not going to tell on you or anything like that. Just trying to get a sense, right, of where the audience stands here, and then also probably can help us as we go through the rest of our presentation, where to spend time. And those of you who strongly agree, I am open for you to connect with me so I can talk to you. Connect with me on LinkedIn so I can figure out the reasons that you're able to say that. So what are some of the best practices, specific best practices that your organizations are using, always looking to increase my knowledge here. I'm going to leave the polling question up for another 3 seconds or so, and then we're going to go ahead, take a quick peek at those results. All right, let's go ahead and share those real quick. All right, so it looks like we've got strongly agree, 19%, that's good. 50% agree, so we still got, at least 30% that are neutral or disagree. So hopefully we are going to give you the incentive to look at the business case and the value in terms of increasing your cash forecasting success. So kind of interesting there. All right, let me go ahead and turn the floor back over to John, and we're going to pivot into a little bit about the forecast categories that are driving the variance and maybe a little bit why.
Yeah, sure. So, obviously Ernie kind of went through a couple of these categories already in terms of how your forecast is typically characterized, but, predominantly it's at least in this high level categories in terms of your forecasting your accounts payable, that, the AP invoices that are being paid on a day-to-day basis, your AR, and typically maybe you're breaking that down by business lines as well to be able to really understand, how cash is moving into the business that way. Capital expenditures obviously are a key part of that, right? Those tend to be some of your major, one-time cash outflows that you see within your business, and also sometimes unpredictable, like CapEx can be pretty choppy during the course of the year, and maybe it's representing some pretty significant outflows in certain months and not other months, right? So your non-operating cash flows, so a lot of your investing activities and things like that that are flowing through your business is the other category there. And then all the other sort of stuff that tends to fall into the forecast, the one-time things, and all those types of items as well, right? And obviously these are all coming from totally different sources. So when you're thinking about your cash forecasting accuracy and ultimately going back to tie to why things did or did not turn out the way that you thought they were going to, you're going to be looking back to different source data for every single one of these. AR, you're going to be going back to the accounts receivables team. You're going to be looking at things like DSO, or even at the invoice level, that we received the receipts that we thought we were going to. Was somebody late paying, versus CapEx, where you're going to be looking at probably totally different items there. Was a project accelerated or delayed or something like that? Did that result in a variance in cash flow there? And then, there are a lot of things that probably cause, unpredictability in the forecast. That, a few of the ones here that really jump out to me is, supply chain disruptions, which a lot of organizations have dealt with over the last 2 or 3 years, and particularly the past, year or so, right? Geopolitical dynamics is probably another thing. Invoice disputes, right? Stuff that's kind of out of your control. Maybe invoices aren't being paid because there's a dispute with that particular supplier about pricing. Good things to keep an eye on, though, because if there's invoice disputes, it could be that there's this huge sort of growing AP balance that's going to come to fruition at some point in time, and you're obviously going to want to know about that and be prepared to take advantage of that when the time comes. So all important stuff. I think probably the point that Ernie's trying to make with this slide here is that a lot of this stuff is identified through really plugging yourselves into conversations with your peers in these departments, right? Because they're going to have the best sort of viewpoint on any of these types of factors that you might have to consider within your forecast itself. So, and then, more specifically drilling into some of the misalignments in AP that result in unpredictability in cash flow forecast. Misalignment on payment terms is definitely a common one, right? If you're forecasting out that a payables balance is going to be paid out in 60 days, but AP is paying it out in 30 days. That's a big difference, right? You suddenly see quite a bit of cash evaporate from the forecast due to just that sort of basic misalignment on payment terms there as well. Same with payment methods, depending on the payment methods that are being used by the business, this can actually be an advantage for you. If organizations are taking advantage of things like virtual card payments, allows AP to pay those invoices sooner, but Treasury to recognize the cash flow later, right, which results in improvements in working capital there. So really understanding how those are going to get paid and the timing of how they turn into cash, depending on the payment methods that are being used, is an important thing as well. And also a way that I think Treasury can add a lot of value to the AP process by making suggestions there. Managing working capital targets is another big thing. For organizations. We'll talk about this a little bit later on in the presentation, but this is definitely a big one for, sort of being strategic in your forecasting is, understanding your forecast drivers, but then understand if, based on the way you've structured your forecast or how the business is operating, are you optimized from a working capital standpoint, or could you be, sort of making improvements in liquidity just by improving working capital targets and things like that. So definitely a few good ones to think about here. And then, variance analysis, in terms of how organizations might go about this, quite essentially, yes, you're always doing sort of a forecast to actual comparison. For me, this was sort of a weekly exercise, right? We'd project out weekly, we track actuals daily, and then at the end of the week, we'd sort of look back and see what did and did not occur in the way that the projection had had predicted those receipts or disbursements to come in, and then ultimately start digging into why that occurred, right? But also just as important, I think, is for forecast versus forecast. And I think these are the questions you get more from the C-suite, the executives within the organization, where the forecast to actual is probably more operational type thing. But a lot of times the questions I get is, hey, why does the forecast from January look so much different than the forecast from November or something like that, right? And then you'd have to sort of tick and tie and bring back those elements to sort of be able to reconcile what had changed between those two forecasts over those time periods here. And then user analysis of the forecast effectiveness. I think the key point here is that the more granularity in the way that you build the forecast, the more detailed your variance analysis can then be, right? So definitely wanted a forecast analysis by key line items. That's what people are really looking to understand. Why are we off on the forecast? Was it our cash receipts from AR collections? Was it our CapEx was more than what we thought it was going to be? And then obviously over time period as well, right? So, and yeah, I mean, it's all a sort of a good learning experience. This variance analysis is meant to sort of, I guess, help you learn more about your business in general. Were there components of cash flow within the organization that you weren't as in tune to, and you need to sort of work those into the forecast going forward? Or is it, can my forecasting methodology be better, right? So it's always just sort of a learning exercise as well.
All right, thanks, John. Let me jump in here. We're gonna time for our next polling question. So I've gone ahead and launched our next polling question here. So asking you to share if you've considered automating your forecast. You're doing it, right, or evaluating? Yes, just starting. I didn't know it was possible. And you might not know. So that's something you definitely want to investigate no matter where you are in the office of the CFO. There's tremendous benefits to doing so. So I'm going to go ahead and leave this polling question up for another few seconds. Again, if you have an interest in receiving a copy of today's presentation and or a certificate of attendance for today's webinar, please send an email to Ernie@treasurywebinars.com. Again, that's Ernie@treasurywebinars.com. So I'm going to go ahead and leave the polling question up for another few seconds, and then we'll take a quick peek here, and then we will let John really show us how a leading technology solution is being used by companies to optimize not only their cash forecasting, but their reporting as well. So let me go ahead and close the polling question here. Just interesting to level set the rest of the conversation. So we have 14 didn't know it's possible, so that's good to know. And you don't know, that's something you find out, something that's in your interest. Everyone can contribute and should be vested in cash forecasting accuracy because that delivers value. It really impacts the bottom line. And so just kind of interesting there to see that we've still got 44% that don't know if that's being done or didn't know it was possible. So let me go ahead and hide the results real quick, and then John, I'll let you go ahead and look at really how this is done, leveraging a leading technology solution.
All right, thanks, Ernie. Yeah, and on the next couple of slides, we'll definitely try to bring a lot of these concepts together and talk about it from the technology lens. So, first of all, this slide kind of highlights what would be the approach here if you were to sort of start to try to undertake an automation or an improvement of your cash flow forecasting process. And it's kind of funny, it's the approach is probably not all that complex. It can kind of be explained through these 8 bullet points over here on the right side. But the complexity comes in the execution, obviously, of that, which is what we'll kind of cover in the 3 subsequent slides from this one as well. So first of all, the approach 1 and 2 here is just about understanding the drivers, right, of your cash flow, your bank activity, as well as your forecast drivers, things like your working capital, your AP invoices, your AR invoices, right? So really understanding where that information is coming from. Defining the horizon that you want to forecast over is an important one as well, right? Are you looking to do a forecast over a 8-week period, a 13-week period, 26 weeks, or longer than that? Because obviously, depending on your objectives for your organization, different data is going to facilitate that forecast over different time periods, which really ties into number 4 here, which is identifying your cash forecasting sources per time horizon. So in the near term, you're probably looking a lot more closely at your ERP data and some of your sort of one-time items, your treasury payments and things like that, CapEx, and some of these other non-operating cash flows as well. Whereas if you're looking at longer-term cash flows, you're probably looking more to the P&L projections, the financial projections, your Hyperions and OneStream type systems as the sources for that information. 5 is really critical. I think that's the bringing it all together in one platform, right? This is where I think organizations tend to falter in building their forecast the most. Is the complexity comes in aggregating all this data, standardizing it, getting it to sort of be consistent enough to actually build a forecast based on it. So this is a key part. Talk a little bit about some strategies for this over the next couple of slides too. And then defining your logic for this. How is the system ultimately deriving cash from the inputs that you put in there? How are you breaking that information down from an actuals and a forecast category standpoint? How are you forecasting from a business line versus corporate standpoint? All of those have to be considered. And 7 is somewhat optional, but I'd say a lot of organizations these days are definitely leaning towards trying to incorporate it into their processes in some way, which is applying machine learning and AI to your forecasting methodologies to generate some improvements in the forecast, or at least help you to kind of pick out some of the reasons for variances within your forecast as well. I think it's the other use case there as well. So I'll talk about that a little bit. But when we talk about how to build this, actually, how to kind of execute this strategy, sort of 3 different ways that we typically suggest to our clients. That's the walk approach, the run approach, and the fly approach, which is kind of highlighted on the next 3 slides. So this is sort of illustrating what the walk approach would be. First thing you could probably catch here is that the forecast timeline is kind of in that 10 to 13 week type period here, right? But really where this starts is characterizing your actuals on the left-hand side here. And so you really understand the way that certain receipts and disbursements flowing through your business would be characterized. And this is really a valuable exercise in itself before you even get into the forecasting. Is once you're forced to kind of sit there and put every single cash movement in your business into a certain category, and you have daily reporting on that, you can just gain so much insights into how cash is moving around the business. It's really like a really nice precursor to actually building out the forecast, or at least sanity checking that you have sort of a methodology to address every single one of those types of receipts and disbursements type categories. And then the second part of this, which is kind of characterized by this tealish hill type looking diagram here, the manual uploads. What this is basically saying is for the walk approach, we typically would suggest for organizations not to worry so much about the data integrations, receiving direct feeds of this data from source systems and things like that, which can often be complex. The point here is more so of having the data be complete one way or the other, right? So if that has to be done through manual uploads, through standardized type templates and things like that, that would be recommended versus trying to force a lot of data integrations in place that your organization might not be ready for yet. Because obviously once you get this together like this, you're on a good path to be able to automate your forecast, automate actually the creation of the forecast from this information. And you're also achieving a lot from a data integrity standpoint, where the data is all being loaded into a source system. Everybody knows where those numbers came from, and from a collaboration standpoint, so that if people are making manual adjustments to that forecast, they're doing it consistently in one source system. Everybody can see sort of the ways that those adjustments are being made and things like that too, right? So this is kind of what we characterize as the walk approach. The run approach, here, really what the differentiation here, obviously you still have the actuals and balances classifications on the left-hand side, but really what we're focused on here is, creating a forecast that's based on more granular data from the ERP source. So, maybe historically you've been creating a forecast based on, things like averages, trending averages and things like that for receipts and disbursements. Just getting to the point where you're actually deriving cash from actual open AR and AP invoices within your ERP system increases the accuracy of that forecast so much. It's just a huge step forward for organizations. During this run phase, you can also start to contemplate things like direct data integrations with those source systems, so that that information is coming over automatically from the ERPs, at least on a weekly basis. I think we saw before, weekly is probably the most common frequency for organizations to sort of use there, right? And so, but yeah, the idea in the run phase is really around granularity, and I think better insights into forecast variances and things like that. And then, what we have up on here now is the fly approach. Really, this is organizations once they're sort of really, becoming more complex from a cash forecasting standpoint. Probably the thing that you can see the most from this diagram here is that the forecast horizon has now been extended out to the 12-month sort of time frame, right? So you're actually folding in other information, other sources of data to project out that cash, primarily your P&L sales forecast. You're integrating to systems like Hyperion, OneStream, like I mentioned before, right? As the sources of those sources of that data. You're having forecast methodologies in place to turn those items into cash and things like that too. And I think in this stage, you can start to also incorporate in things like AI and machine learning, not even if it's not necessarily from the standpoint of building your forecast for you, because that just takes a lot of data, a lot of real consistent data to do using AI and machine learning. But what you can do is you can look at historical payment behavior like we have here, so that if you have, say, for example, cash receipts based on certain key payers paying you in 40 days that are, driving some of your cash receipts in your forecast, the AI and machine learning can look into that and see things like, hey, you're projecting these out based on 40 days because those are the terms with that particular customer, but they consistently pay in 55, 60 days, right? So this is sort of a red flag. This is what might go wrong in your forecast based on the way it's been built, right? And so this is really the fly approach. This is when organizations get very sort of complex, sophisticated about their forecasting as well. And yeah, this last one kind of just brings it all together. I think probably the only thing that really highlight on this slide here is that it's a layered approach, right? Where you start in the stream probably depends on, where you are now. Maybe you're already at the walk stage and you aspire to get to the fly stage. Maybe you're really basic still in Excel, or you don't have a forecast at all and you're aspiring to get to the walk stage. And it's not as if you can't move from one stage to the next. It's more about, tying your objectives as a business to the particular, amount of work that needs to be done to achieve that. So for walk, there's a lot you can accomplish, obviously, from a business standpoint, and start to see some of these efficiencies quickly, rather than just trying to jump to the conclusion here, which is a fully integrated AI-based cash flow forecasting solution, right? Which might not be what drives near-term value for the organization.
Thanks, John. I really appreciate you diving into that, and it's really the logic behind it and the step-to-step process, right? So you might not, it might be dangerous. I don't know, you can try, but going from walk to fly, right? There's a lot of steps that go in there. So I appreciate, just giving some of that insights and just a few notes. I mean, from what I've seen from research also is that companies find it very difficult to even create a cash forecast, let alone do some scenario analysis. I think on the AI side of it and machine learning, to me, right, we hope we understand the drivers of our variance analysis, but being able to run the scenario analysis based on at least past data can show us if we are looking at the right drivers, right? Or if there might be a new driver, right, into our forecast, lets us really look at that, right, without causing damage, I'll put it that way, to what we're going to use the data to inform those decisions. So incredibly exciting time. So this is something that I really haven't seen enough of. So John and Ernie, yeah, this is great, cash forecasting, accuracy, we get it. But how would I just go about, right, a really simple framework to look at the ROI of that increased forecasting? So just want to share that with you, go over that really quickly. And this made me think, right, because this is something that I've always wanted to see. So you have your net savings, I would call that benefit, right? Your gross savings, which is the benefits that you can quantify, right? And then we have our OPEX, obviously, depending on the process, if it's a subscription-based model, or CapEx if it's a one-time expense for your solution. So depending on what type of technology that you choose to implement, those can be ongoing expenses, or however you choose to look at the CapEx side of it in terms of your time frame on your net savings. So just to give you a little bit of insight into where you can see and quantify your automation savings in terms of just the time and effort spent in terms of creating that forecast, depending on where you stand in terms of whether you're a net borrower, right, or you're a net investor. You can have an increase in interest income potentially, right, making sure all your funds are invested, not only invested maybe in the US, but invested correctly across the world. You could see a decrease in interest expense. It can keep you from borrowing, which when you don't want to, and then it can also add to a decrease, I would call FX losses that hit your P&L statement. So it can help you from entering into suboptimal arrangements, and this could be not only FX, it could be commodity swaps as well. So just kind of looking at all those different areas, and I probably have missed something. So any way you're using information to impact decisions, and if you see, okay, giving better information about the cash forecast would have done X, Y, Z. So a scenario analysis, right? We did this. If I would have known this number was 5% or 10% higher level, we would have done this, and that helps you start to quantify that. So then reduction in variance, so just gives you a little bit more specifics there. It helps you invest the correct amounts and durations for your interest income side of it. FX trades in the correct amount and frequency, mitigate your FX losses, and then reduce your bank balances, results in reduced borrowing. So I think it's really important that we show you how to easily make that business case. So let's talk about cash forecasting success. The bottom line is I do that. I'm going to go ahead and launch our final polling question here today. I appreciate everyone's consideration in not only answering the polling question, but also supporting my thought leadership partner, TIS as well. So let's hit the bottom line. We talked about these. Let's put a fine point on it before we part for today. Clearly define the goals of your forecast, understand your data, work closely with AP, AR, and company leaders to capitalize on what impacts cost and revenues. And the goal is to take more control over your cash movements that will improve predictability, identify the drivers of your cash forecasting accuracy, understand the drivers of your cash forecasting accuracy, and invest in the right technology and the right solution partner. Investing in the right solution partner can be a game-changing experience for your career success. We don't get a lot of opportunities in Treasury to lead in terms of technology adoption, so we need to take complete advantage of those opportunities. So I'm going to go ahead and leave the polling question up for another few seconds or so just to make sure everyone has a chance to answer the polling question. Again, please just press the button for me. I sincerely appreciate that. So let me go ahead and close. And so, John, we have maybe a minute or two left. And so, first of all, John, thank you so much for being an amazing speaking partner as always. But I'd like you to share with us, TIS has a webinar later this week with the Assistant Treasurer of Manpower. I've invited everyone to that. So if you want to be registered and have not yet, please let me know. John, can you give us a little bit of a preview on what you'll talk about?
Yeah, sure. I mean, thanks for bringing that up too, by the way. So yeah, later this week we'll be speaking with the treasurer of Manpower Group, who's going to take us through one of their use cases, sort of how they approached primarily what was at first a treasury management system implementation that involved sort of revamping a lot of the foundational cash management type processes with them, but sort of took a long view on it and ultimately put in place a technology solution in what was TIS to act as sort of a connectivity hub to facilitate the bank communications to the TMS, but then more broadly, other applications, the biggest one being sort of a looming Oracle cloud migration that the organization had planned that was going to impact, all business units globally. So we're really just going to talk through those types of situations and really how he put in place a, sort of a really valuable tool that helped them facilitate a lot of efficiencies in terms of aggregating connectivity channels and bank communication channels and ultimately simplifying that Oracle cloud migration. So hope everybody can join. Should be a good chat.
All right, thanks, John. So if anyone would like me to share with you again the webinar invitation for that webinar that we talked about with TIS and Manpower Group, please send an email to Ernie@treasurywebinars.com. Also, if you'd like a copy of the presentation or a certificate of attendance, Ernie@treasurywebinars.com. One more final thank you to my strategic partner, TIS. Their commitment to thought leadership is strong and long-standing. We've been working together, I believe, 6 or 7 years. Absolutely one of my most valued partners. I appreciate their continued collaboration. Everyone, make the rest of your day great. Until next time.